The IRS recently released the new inflation-adjusted tax rates for 2024. As we enter the new year and the tax filing season approaches, it's important to understand that your tax bill is largely determined by the tax brackets the IRS sets. Worry not if you're a beginner and don't understand how tax brackets work. In this video, we're going to explain simply how tax brackets work and what they mean for your money. By the end, we're going to mention 2 methods any individual can use to reduce their tax bills, so stay tuned. Welcome back to PST Finance. Before we get into how tax brackets work, we need to explain first what they are. A tax bracket acts as a range of income subject to a certain income tax rate. Tax brackets are part of what's called a progressive tax system, in which tax rates progressively increase as a person's income grows. People with lower incomes fall into tax brackets with relatively low income tax rates, while those with higher incomes fall into higher rates. Currently, there are 7 federal tax brackets in the United States, with rates ranging from 10% to 37%, depending on your income and filing status. How do they actually work? Tax brackets might initially seem extremely complicated, but they're quite simple. The most important thing to know about them is that unless your total income falls into the lowest tax bracket, you are charged at multiple rates according to the additional tax brackets into which your income flows. If this still sounds complicated, here's an example for you. Suppose you get paid $11,600 or less, and you're filing for your taxes individually. Then the tax rate on your income is 10% since $11,600 or less is the lowest tax bracket. This would result in paying a tax of $1,160. Let's say your income falls in the range of $47,150 to $100,525, and your filing status is also single, like in the previous example. Then you'd fall into the 3rd tax bracket, and your tax rate would be 22%. A common misconception regarding tax brackets is that if your income falls into a certain bracket, your entire income is taxed at that bracket's rate. However, this isn't the case. In fact, your income will be taxed at what is called an effective tax rate. Think of it like a ladder. The first step of your income, which is up to $11,600, whether you are an entry-level employee or the CEO, is taxed at 10%. And as your income increases and you take another step up the ladder, it gets taxed at 12%, then at 22%, and so on. So if your annual income is $100,525, how much taxes would you pay? Before we go into details to answer this question, you need to know that the government allows you to deduct a certain amount from your income in order to reduce your taxable income. Let's say that your filing status is single, like in the previous example, then you'd be entitled to a tax deduction of $14,600, which is the new standard deduction for 2024 and a $750 increase from 2023's standard deduction. It's important to note that anyone is entitled to the standard tax deduction, but it could differ depending on your filing status, a point that we will come back to later. Back to our example, you could deduct $14,600 from your $100,525 income, leaving only $85,925 for you to pay taxes on. Now, let's get into the tax brackets. The first $11,600 of your income, aka the maximum income for the first tax bracket, would be taxed at 10%, leaving you with $71,325 in taxable income and $1,160 in taxes. Then you'd enter a new tax bracket that is up to $47,150, which means that $47,150 from your $71,325 would be taxed at 12%, leaving you with $24,175 in taxable income and $5,658 in taxes. The remaining $24,175 would enter the 3rd tax bracket and be taxed at 22%, leaving you with taxes of around $5,318. So the full tax you would have to pay is the sum of these 3 numbers, meaning you'd add $1,160, $5,658, and $5,318 to get a tax of $12,136 on your taxable income of $85,925. And once you pay that, you'd be left with $73,789 for yourself. This would give you an effective tax rate, which is essentially a blended rate of all the rates of your tax brackets, of approximately 14%, a rate that is significantly less than the 22% tax rate of the tax bracket the $100,525 falls into. You get this rate by dividing the amount of taxes you pay, which is $12,136 in this example, by your taxable income, which is $85,925. One easy way to save on your taxes is by understating your filing status, since it can have a massive impact on your tax brackets and standard deductions, and therefore the amount of taxes you pay. In the example, we used the single filing status, but there are other statuses, such as filing jointly with your spouse, filing separately with your spouse, or filing as the head of the household. All of these have obvious meanings except the head of the household. So we're going to explain the requirements to become the head of the household. For starters, you have to be an unmarried person and have a qualifying dependent. This qualifying dependent must generally be your child or your parents, and by filing as the head of the household, you get a higher standard tax deduction of $21,900 compared to single filers' $14,600. Also, married couples who file their taxes jointly also receive a higher standard deduction, which equals $29,200. So far, this covers federal income tax brackets, but state income tax is a whole other ballgame. In fact, tax regulations could differ from one state to another, with some states even having no income tax. These states include Alaska, Florida, Nevada, South Dakota, Tennessee, Texas, Washington, and Wyoming. Tax brackets also vary across states. For example, California, Iowa, and Missouri had 9 brackets in 2022, while Hawaii had 12. Not only that, but the tax rates in those brackets could vary considerably. For instance, California has the highest in the states mentioned, maxing out at 12.3%. So you must research your state's tax regulations and understand them extremely well. So now that we've cleared up the common misconception that you don't actually owe the IRS the actual tax rate of your tax bracket, we're going to explore 2 methods that anyone can use to lower their taxes. One method is making charitable donations. A charitable donation is a gift of either money or goods to a tax-exempt organization, which can reduce your taxable income. In order to make use of this, you must donate to an IRS-recognized charity and receive nothing in return for your gift. Some examples of organizations you could donate to for tax benefits are religious organizations, the Red Cross, nonprofit educational agencies, museums, volunteer fire companies, and organizations that maintain public parks. It's important to make sure that the organization you plan on donating to is IRS recognized, since some donations don't count as tax deductions. For example, you can't receive tax benefits from donating to a friend's GoFundMe. This isn't a hard process at all. In fact, you can verify an organization's status with the IRS Exempt Organization Select Check tool. After donating, it's important to keep track of your donations no matter how small, since you'd need these documents to prove your donation in order to get a tax deduction. Some examples of these documents include a bank statement, a credit card statement, or a receipt from the charity. Finally, you have to keep the deadlines in mind. For your donation to be considered tax deductible when you file, it must have been made by the end of that corresponding tax year. For example, you have until December 31, 2024 to make donations you want to claim on your 2024 tax return, which gets filed by April 2025. Generally, you can deduct up to 60% of your adjusted gross income via charitable donations. Still, you may be limited to 20%, 30%, or 50%, depending on the type of contribution and the organization. Hence, it's important to check before you make the donation and itemize your tax deductions. Another way you can reduce your tax bill is by saving for your retirement. Your taxable income can be reduced for contributions up to $23,000 to a 401k or 403b plan in 2024. Let's say you earn $100,000 annually and contribute $23,000 in 2024 for your 401k plan. Then this would reduce your taxable income to only $77,500. If you don't have a workplace retirement plan, you could still get a tax break by contributing up to $7,000 or $8,000 if you're 50 or older to a traditional individual retirement account, or IRA, in 2024. The deduction for IRA contributions is phased out for adjusted gross incomes at different levels, depending on whether they're claimed on a single taxpayer's return, a joint return, or by a married individual filing separately. This shows the importance of doing your research and understanding the IRS rules for these tax benefits before you start making contributions to your retirement accounts. To conclude, it's important to pay all that you legally owe to tax authorities, but nobody has to pay extra. This is why you need to understand your tax brackets well, do your own due diligence, and research your state's tax regulations, since they can differ from one state to the other. A few hours on the IRS website can save you a lot of money you could be paying in taxes, so try to learn as much as you can, and even seek a tax professional's advice if needed. Make sure you qualify for tax deductions, whether you'd be using strategies like donations or savings to protect your income from higher taxes, then enjoy the money you saved because of your diligence. Well, that is everything for now. Please let us know what you think in the comments below, and if this video helped you understand tax brackets. And if you haven't, please subscribe and leave a like for this video. Your support helps us continue our work. Thanks again for your support, and I will see you in the next one.